The dawn of a new Social Security era in 2026. Welcome to a critical update for millions of American seniors. As we enter 2026, the Social Security Administration, or SSA, has implemented one of the most significant rule changes in recent history. For the over 70 million Americans currently receiving some form of benefit, whether for retirement, disability, or survivor support, the financial landscape has fundamentally shifted. This isn't just a minor administrative adjustment, it is a profound change that directly impacts how your benefits are calculated, when you can claim them, and exactly how much money hits your bank account each month. The situation is becoming increasingly alarming because thousands of retirees are still making life-altering financial decisions based on outdated rules. By following the old system, many seniors are unknowingly leaving hundreds of dollars on the table every single month. In an era where every dollar is vital, this gap between new government policy and public awareness can lead to costly mistakes that jeopardize your financial security for decades. While the SSA publishes updates in the Federal Register, they often expect you to stay informed without providing a personal, simplified explanation. Today, we are cutting through the dense government jargon to bring you straight, honest answers. We are moving beyond the confusing fine print to explain exactly what has changed, who is impacted, and the immediate, simple steps you can take right now to protect your income. Whether you are already receiving checks or are planning to claim soon, the decisions you make in 2026 are pivotal. We will walk through these 2026 updates step by step, ensuring you are empowered with the facts to secure the retirement you have worked a lifetime to earn. The evolving earnings limit for working seniors. One of the most immediate and impactful shifts in 2026 involves the earnings limit for seniors who choose to continue working while receiving Social Security benefits. This is a critical area because today's retirement looks very different than it did 30 years ago. Many of you are consulting, working part-time, or managing small businesses to combat the rising cost of living. However, if you have not yet reached your full retirement age, the SSA applies what is known as the Retirement Earnings Test. In 2026, the thresholds for this test have been updated. If you are under your full retirement age for the entire year, the SSA will deduct $1 from your benefit payments for every $2 you earn above the annual limit. Crossing this line unknowingly can lead to a sudden, unexpected reduction in your monthly check. For a senior relying on that income for rent or groceries, such a surprise can be financially devastating. The key takeaway for 2026 is that you must be hyper-aware of where this line is drawn. As inflation continues to fluctuate, these annual adjustments by the SSA are designed to keep pace, but they also create a moving target for your personal budget. We are seeing more seniors than ever before being caught in this earnings trap, simply because they are trying to stay active and productive. Understanding this limit isn't just about compliance, it's about protecting your immediate cash flow. Debunking the permanent reduction myth. There is a widespread misconception that when the SSA reduces your benefits because of the earnings test, that money is gone forever. This is simply not true, and clearing up this myth is essential for your long-term planning. While the short-term reduction is real and can cause immediate stress, these withheld funds are actually credited back to you later. Once you reach your full retirement age, the Social Security Administration undergoes a recalculation process. They look back at all the months where your benefits were reduced or withheld due to your earnings, and they adjust your monthly benefit upward. Essentially, by working and having benefits withheld now, you are inadvertently buying a higher monthly check for your later years. In the eyes of the SSA, you are delaying a portion of your benefit, which results in a permanent increase once you hit that FRA milestone. However, the frustration factor comes from the lack of transparency in how this happens. The SSA doesn't send a clear receipt showing your saved money. This is why 2026 is a year for meticulous record keeping. You need to know exactly how many months your checks were adjusted so you can verify the SSA's recalculation when the time comes. We want you to see these reductions not as a lost tax, but as a forced savings plan that will eventually boost your lifestyle in your 70s and 80s. Knowledge of this mechanism transforms a moment of financial frustration into a strategic long-term gain. The full retirement age, FRA transition crisis. As we navigate 2026, we are witnessing a pivotal transition for the cusp generation, those born in the late 1950s and early 1960s. The definition of full retirement age has been a moving target for years, and in 2026, the confusion is reaching a boiling point. For those born between 1943 and 1954, FRA was 66. But for anyone born in 1960 or later, that age has officially shifted to 67. The danger lies in the months between. Many seniors are operating under the assumption that they are safe to claim at 66, only to realize too late that their FRA is actually 66 and 10 months or 67. Claiming even a few months before your true FRA results in a permanent reduction of your monthly benefit. Over a 20-year retirement, this minor mistake can cost you tens of thousands of dollars. The 2026 rule changes emphasize that the SSA is strictly enforcing these age thresholds. There is no grace period for being misinformed. This is particularly critical because the SSA's communication can be opaque. They provide the data, but they don't always provide the context. We are seeing a surge in seniors who accidentally lock in lower rates for life because they didn't double-check their specific birth month requirements. In 2026, close enough isn't good enough when it comes to your retirement age. You must know your FRA down to the exact day to ensure you are receiving 100% of the benefits you earned through decades of hard work. The strategy of delay. Why months mean thousands. If you are approaching retirement in 2026, you have likely heard the advice to wait as long as possible. But in 2026, this isn't just a suggestion. It is a high-stakes financial strategy. For every single month you delay claiming Social Security past your full retirement age, up until age 70, your benefit increases by a fixed percentage through delayed retirement credits. This results in an 8% annual increase. In a world where high-yield savings accounts struggle to offer 4 or 5%, an 8% guaranteed return from the government is arguably the best investment available to American seniors. However, the reverse is also true. Claiming early, at age 62, results in a reduction of up to 30% compared to your FRA amount. In 2026, with the cost of healthcare and housing soaring, that 30% gap is the difference between a comfortable retirement and one defined by financial anxiety. We are urging seniors this year to look at their benefits not by the year, but by the month. Waiting just 3 additional months can permanently boost your check by a noticeable margin. This is a permanent, inflation-adjusted raise that you give yourself. Before you sign those papers in 2026, run the numbers for 3 months out, 6 months out, and 1 year out. You might find that the short-term sacrifice of working a few more months leads to a lifetime of significantly higher security. Don't let the retirement fever of 2026 push you into a decision you'll regret in 2036. The tax trap. Why 85% of your benefit might be taxable. Perhaps the most shocking reality for retirees in 2026 is the taxation surprise. Many seniors grew up believing that Social Security was tax-free because they already paid into it during their working years. Unfortunately, the IRS has a different perspective. Depending on your combined income, which includes your adjusted gross income, non-taxable interest, and half of your Social Security benefits, you could owe federal income tax on up to 85% of your benefits. In 2026, this is becoming a tax trap for more seniors than ever before. Why? Because the income thresholds that trigger this tax have not been adjusted for inflation since they were created decades ago. As the cost of living goes up and seniors earn slightly more from part-time work or required minimum distributions, RMDs, from their IRAs, they are being pushed over these stagnant limits. What used to be a tax on the wealthy is now hitting middle-class retirees. In 2026, a senior who receives a modest pension and a Social Security check may suddenly find themselves owing thousands back to the government. This is a silent benefit cut. We are seeing a growing number of seniors who see their COLA increase erased by a higher tax bill. Understanding how your total income interacts with these 2026 tax rules is the only way to keep the IRS from taking a massive bite out of your retirement pie. Strategic shielding, protecting your benefits from the IRS. Now that we've identified the tax trap of 2026, the question is, how do you fight back? In 2026, proactive tax planning is no longer optional. It is a survival skill. Many seniors are successfully using shielding strategies to lower their combined income and keep more of their benefits. One common method is utilizing Roth IRA conversions or withdrawals, as qualified Roth distributions do not count toward your combined income for Social Security taxation. Another strategy involves managing the timing of your required minimum distributions. In 2026, if you are over 73, you are forced to take money out of your traditional IRAs, which can skyrocket your income and trigger the 85% tax on your Social Security. By working with a financial advisor to balance these withdrawals, you can stay just below the tax thresholds. Furthermore, some seniors choose to have federal taxes withheld directly from their Social Security checks. While this doesn't reduce the tax owed, it prevents a massive, painful bill at the end of the year. In 2026, the difference between a senior who plans and one who doesn't can be $3,000 to $5,000 a year in found money. We are entering an era where it's not about how much you make, but how much you keep. We strongly recommend a tax checkup in the first quarter of 2026 to ensure you aren't leaving your hard-earned benefits vulnerable to avoidable taxes. The Medicare Social Security collision. A major point of confusion in 2026 is the invisible link between your Social Security check and your Medicare coverage. For the vast majority of seniors, the premium for Medicare Part B is deducted directly from their Social Security benefit before the money ever reaches their bank account. In 2026, Medicare Part B premiums have been adjusted again, and for many, this adjustment can swallow up their annual cost of living increase. This creates a phenomenon we call the net benefit stagnation. You might hear on the news that Social Security is going up by 2 or 3%, but when you look at your actual deposit in January 2026, it might be exactly the same as December. This happens when the dollar amount of the Medicare premium increase is equal to the dollar amount of your COLA raise. It feels like a bait and switch, but it is a standard part of the system's design. In 2026, it is vital to look at your notice of change from the SSA, which breaks down your gross benefit versus your net benefit. Understanding this collision helps you budget accurately. You cannot plan your 2026 grocery budget based on your gross increase. You must plan it based on what is left after Medicare takes its cut. This relationship is one of the most cited frustrations for retirees, and staying informed is the only way to avoid the shock of a vanishing raise. The hold harmless provision, your financial safety valve. While the collision of Medicare and Social Security can be frustrating, there is a powerful legal protection in place for 2026 known as the hold harmless provision. This rule is a critical safety valve for millions of seniors. In simple terms, the law states that for most beneficiaries, their net Social Security check cannot go down from one year to the next as a result of a Medicare Part B premium increase. If the Medicare premium hike is larger than your COLA raise, the SSA will reduce your Medicare premium to ensure your check stays at least the same as the previous year. You are held harmless from a decrease in your actual take-home pay. However, there are exceptions. This protection generally does not apply to high-income earners who pay a surcharge called IRMA A, nor does it apply to new enrollees in Medicare for that year. In 2026, knowing whether you qualify for hold harmless is essential for those on a tight fixed income. It provides a floor of security, ensuring that inflation and healthcare costs won't actually result in you having less money for food and rent. We see many seniors panicking when they hear about massive Medicare hikes, but for the majority, the hold harmless rule acts as a shield. It's one of the few areas where the law is explicitly designed to prevent seniors from falling backward financially. The digital shift, mastering the My Social Security portal. The year 2026 marks a major milestone in the SSA's internal modernization effort. The government is moving away from paper and toward the My Social Security online portal. If you are still waiting for paper letters or trying to handle everything via telephone, you are at a significant disadvantage in 2026. The portal is now the primary hub for viewing your benefit statements, checking your earnings history, and verifying your 2026 COLA notice. Why is this digital shift so important right now? Because it allows you to catch errors in real time. We have found that thousands of seniors have mistakes in their earnings record, years where an employer didn't report income correctly or a data entry error occurred. These mistakes can lower your monthly check by hundreds of dollars. In 2026, the SSA has made it easier to dispute these errors, but only if you have an online account. Furthermore, the 2026 rule changes mean that certain updates, like changing your direct deposit or updating your address, are processed much faster online than through the mail. We are urging every senior watching this to set up their account at SSA.gov this week. It is free, secure, and it gives you a financial command center where you can see exactly what the government sees. In an era of shifting rules, having instant access to your data is your best defense against administrative errors. Public sector workers, the WEP and GPO reality. For our viewers who served as teachers, firefighters, police officers, or other government employees, 2026 brings renewed focus on two of the most controversial rules in the system: the Windfall Elimination Provision, WEP, and the Government Pension Offset, GPO. If you have a pension from a job where you didn't pay Social Security taxes, these rules can drastically reduce or even eliminate your Social Security benefits. In 2026, there is significant legislative debate surrounding these provisions, as many argue they unfairly penalize public servants. However, as it stands today, these rules are still in full effect. For those affected by WEP, your retirement benefit is calculated using a different formula that can reduce your monthly check by up to 50% of your pension amount. For those affected by GPO, your survivor or spousal benefits can be reduced by 2/3 of your government pension. This pension penalty catches many seniors off guard right as they prepare to retire in 2026. If you fall into this category, your My Social Security estimate might be wrong because the system doesn't always know about your outside pension yet. You must manually calculate the WEP GPO impact to know your true 2026 income. Staying informed on the latest congressional votes is also vital, as any reform in 2026 could result in an immediate and significant raise for millions of public sector retirees. The trust fund alarm, separating fact from fear. In 2026, you cannot turn on the news without hearing a scary headline about the Social Security Trust Fund running out by 2035. This creates an atmosphere of panic that leads some seniors to make poor decisions like claiming benefits way too early just to get what they can. As we analyze the 2026 landscape, it is time for a reality check. Social Security is not disappearing. Even if the trust funds were to be depleted in the mid-2030s, the system would still be collecting billions in payroll taxes from current workers. According to the SSA's own trustees, the program would still be able to pay out approximately 80% of scheduled benefits. While a 20% cut would be a serious issue that Congress would likely act to prevent, it is a far cry from the zero that alarmist headlines suggest. Historically, Congress has always stepped in before a crisis, most notably in 1983. In 2026, the best strategy is not to panic, but to diversify. Ensure that Social Security is the foundation of your retirement, but not the only floor. By understanding the true health of the system, you can ignore the noise and make rational, long-term decisions based on your health and financial needs rather than fear-based headlines. Your 2026 checks are safe, and the program's political protection remains one of the strongest in Washington. The March 2026 payment confusion. What's really happening? There has been a lot of chatter online and on social media about a missing or canceled payment in March 2026. Let's set the record straight. The SSA is not canceling your March payments. This confusion stems from a combination of the 2026 calendar layout and the SSA's internal modernization restructuring. For a small group of beneficiaries, particularly those who receive both Social Security and Supplemental Security Income, SSI, the timing of your deposits might look different this month. Because of how weekends and holidays fall, some SSI recipients may receive their March payment at the very end of February, while others may see their Social Security check arrive a day or two later than usual due to new processing windows. This isn't a loss of money, it is a scheduling shift. However, for those living check to check, a 2-day delay can feel like an eternity. In 2026, it is more important than ever to mark your specific payment date based on your birthday on a physical calendar. Remember, 1st 10th is the 2nd Wednesday, 11th 20th is the 3rd Wednesday, and 21st 31st is the 4th Wednesday. If you receive SSI, you are paid on the 1st of the month. Don't let viral misinformation cause you unnecessary stress. Your money is coming. You just need to know exactly when to expect it. Eligibility reviews and the scam surge. As the SSA rolls out stricter verification processes in 2026 to reduce overpayments, they are conducting more periodic eligibility reviews. You might receive an official letter asking you to confirm your address, marital status, or income. While this is a standard administrative step, it has unfortunately opened the door for a massive surge in Social Security scams. Scammers are taking advantage of the 2026 changes by calling, texting, or emailing seniors and claiming that their benefits will be suspended or frozen unless they provide personal data or pay a reactivation fee. Here is the absolute truth for 2026. The SSA will never call you out of the blue to demand immediate payment. They will never ask for payment via gift cards, wire transfers, or cryptocurrency. They will never threaten to arrest you over the phone. Official communication from the SSA almost always starts with a letter in the mail or a notification in your secure My Social Security portal. If you get a suspicious call in 2026, hang up immediately. If you are worried it might be real, call the official SSA number yourself at 1-800-772-1213. Protecting your identity is just as important as protecting your check this year. Don't let a scammer use the 2026 rule changes as a weapon against your peace of mind. The 2026 COLA Boost and your final action plan. We conclude our 2026 Social Security deep dive with the news everyone has been waiting for, the official cost of living adjustment, or COLA. While the exact percentage is finalized late in the year, the 2026 boost is designed to provide real, tangible relief against the rising prices of groceries, utilities, and medicine. For those on SSI, this increase actually kicks in at the end of December 2025, while retirement and SSDI recipients will see it in their January 2026 checks. This raise isn't just a bonus, it's a recognition of your hard work and the reality of today's economy. As we wrap up, here is your 2026 action plan. First, log into your My Social Security account this week to verify your data. Second, double-check your full retirement age down to the specific month. Third, review your tax strategy to see if you can shield your benefits from the 85% tax trap. And finally, stay vigilant against scams. You have spent decades paying into this system. It is your right to receive every penny you are owed. We at Secure Senior Income are honored to be in your corner, providing the clarity you need to navigate these changes with confidence. 2026 is a year of transition, but with the right information, it can also be a year of incredible financial security. Thank you for watching, and remember, your retirement is your reward. Protect it with everything you've got.